Hey everyone, welcome back to Corporate Dakota. Today, TFC just filed its second quarter 2026 report, and I'm seeing some interesting trends in their loan performance and market positioning. Quick note, this is not financial advice, just my take on public filings for educational purposes. Truist is showing some resilience in a tough market, but a closer look at their loan books reveals where the real story is. So here we are with TFC's quarterly report looking at their financial health in the second quarter of 2026. First, let's peek at the big picture on their balance sheet. Total assets are around $556 billion, up slightly from the end of last year. This growth is mostly in their loans and leases, which is expected for a bank. What is interesting is that their securities portfolio, both available for sale and held to maturity, is also substantial. Now let's dive into how they made money. Net interest income, which is the core of a bank's business, was about $3.6 billion for the quarter. That is a slight increase from last year, but you can see their interest expense on deposits is also climbing. What really stands out is their non-interest income. It jumped up to $1.6 billion this quarter, a good 17% increase. This growth is being powered by their investment banking and trading income, which shot up significantly. Wealth management income also saw a nice boost. This tells me they are leaning more on these fee-based services, which can be more stable than pure lending in uncertain times. On the expense side, personnel costs are up, which is common with higher revenues and potential bonuses, but they managed to keep overall non-interest expense relatively flat compared to last year. That is pretty good cost control. The bottom line looks healthy. Net income available to common shareholders was about $1.5 billion for the quarter, a solid 29% increase from the year before. That translates to earnings per S-share of $1.23, up from 90 cents last year. Now let's talk about loans. The provision for credit losses, which is basically money set aside for loans that might not get paid back, was $395 million. This is actually lower than last year, which is a good sign for the overall quality of their loan book. Looking at their allowance for loan and lease losses, or ALLL, it is sitting at about $5 billion as a percentage of their total loans, that is around 1.5%. This ratio has actually dipped a bit, suggesting they feel more confident about their borrowers. But here is where we need to pay attention. While overall non-performing loans are still relatively low, there is a specific category that is worth noting. Loans that are 90 days or more past due and still accruing, meaning they are technically not considered bad yet, are at about $698 million, and that is stable compared to the end of last year. The residential mortgage portion, especially the government guaranteed ones, makes up a significant chunk of that. It is not a red flag yet, but it is a number to watch. And when we look at their commercial real estate loans, a sector that has been under scrutiny, their top property types are multifamily and industrial. Multifamily loans, which are generally considered more stable, are a large portion of their CRE book. However, their office loan exposure, though smaller, has a higher percentage of non-performing loans, which is something to keep an eye on. For their commercial and industrial loans, they have a pretty diverse industry spread, with finance and insurance being the largest category. But within that, information and wholesale trade show a higher proportion of non-performing loans. This suggests specific industries within their commercial book are facing more headwinds. Financially, Truist seems solid. Their credit ratings from agencies like S&P and Moody's are generally good, indicating a stable outlook. Truist is actively returning capital to shareholders, repurchasing about $2.4 billion of its own stock in the first half of 2026 and paying out dividends. This shows confidence from management, but it also means less capital available for other investments or to absorb potential future loan losses. Looking at their business segments, consumer and small business banking is showing really strong growth in net income, up 45% year over year. Wholesale banking also saw a decent jump. The other Treasury FUNIAMP corporate segment, however, is reporting a net loss, which is typical as it handles many of the company's overhead and interest rate management functions. Overall, Truist is painting a picture of strong performance with earnings per share up significantly. They're highlighting disciplined execution, higher fee income, and strong credit performance. But as we saw, those slight upticks in certain loan categories warrant a bit more attention. The CFO, Michael B. Maguire, and the team are clearly focused on balancing growth with risk. One interesting legal note is the settlement of the Bickerstaff v. SunTrust Bank case. They've agreed to a settlement of up to $240 million to resolve overdraft fee claims. While this is a significant amount, it is less than the initial potential claim, and the final payout will depend on how many people file claims. This is a good example of how legal settlements can impact a company's financials. When we look at their return on tangible common equity, or ROTCE, it is a pretty impressive 15.4% for the quarter. That is a strong number showing good profitability relative to their tangible assets. So, what is my take? Truist is performing well in its core banking and fee-generating businesses. The executive team is actively managing capital and seems to have a good handle on overall risk. However, my biggest concern is the subtle increase in certain loan delinquencies, especially within the commercial real estate and indirect auto portfolios. While not alarming yet, a sustained trend in this direction could put pressure on their provision for credit losses down the line. It is definitely something to monitor closely in their future filings. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded, like, comment, and subscribe for more deep dives. Check out the Discord in the description.